All right, episode number 324, Retirement Dashboard. I'm looking forward to getting into this program with you. But before I do, there are a couple of topics that I just wanted to touch on. These are things that I've seen coming up time and time again. The first one I want to talk about is gold. I've had a lot of people reaching out to me recently asking about investing in actual physical gold, either gold coins or gold bullion, and holding that gold in their house in a safe or protecting it in some way. And I have to tell you, I'm not a huge fan of this idea of buying gold. And the reason I'm not a huge fan of buying gold in that fashion, now, if you want to buy a gold ETF or if you want to buy a basket of commodities as a hedge against inflation, as a way to, with a small portion of your investment portfolio, maybe to help guard against a market decline or inflation, I can understand owning a commodity in a mutual fund or an ETF from that standpoint. But this idea that there's so much fear out there and there's these guys peddling fear, and I think part of the reason we see so much gold being sold is it's very, very unregulated. So unlike buying securities or equities or insurance contracts or anything of that nature that is highly regulated, you've got these guys, everybody and their brothers out there trying to sell gold. And I think they're really the only ones making any money buying and selling gold coins and gold bullion. The reason that it really irritates me or bothers me is because there's so much fear injected into why you should own gold. And in order to own this physical gold, here's what you have to believe. You have to believe that the entire economic system that's been created is going to collapse. And then not only is it going to collapse, but that we're going to go backwards and we're going to start trading one another for goods and services. So in other words, I'm going to flake off a couple of ounces of gold from my gold bullion, and I'm going to bring it to you, and I'm going to trade it to you for bread. I just can't wrap my mind around that type of scenario. I don't see us going backwards as society, as an economy. Could we get into trouble? Could there be financial Armageddon? Could there be a default on debt? Well, sure, there can be. But in America, what we do is we innovate. We look forward. We look for better ways to do things. So this idea that, I'm going to be living in my tent and filtering water and trading gold with people, I'm not going to buy, I just can't buy into that. That's not the way that I see the future. And I really think this gets back to your thinking. It gets back to my thinking. And we have to be really careful about what we think about, because what we think about is going to influence what we say to ourselves, the conversation we're having with ourselves, and then it's going to impact the decisions we make as we go through life. And as soon as you adopt this mentality that we're going to go backwards in time at some point into this bartering system of trading gold for food, you've started down a path that could be very destructive to your financial well-being. And so I want to encourage you to have an outlook in life that says you can be optimistic in the long term for the direction that America is going, but pessimistic about where America may be right now. It's okay to be pessimistic, but what you do then is you create a strategy that says money that you need in the short term you want to be more conservative with, and money that you don't need for the longest period of time you can be more optimistic. You can invest more aggressively with. So that was the first thing. I get these, and it's good people that are looking at owning gold. Now, I understand some of you, no matter what I say, you're going to want to own your gold coins or your gold bullion and keep it in a safe in your house. And if that's the case, as long as it's not more than 5% of your liquid net worth, well, you can do whatever you want with it. You can buy Bitcoin if you want. In fact, I think if we were to get into real financial turmoil, personally, I think I see people innovating and going to new technology more than I see us going backwards into something like gold. So anyways, gold is a store of value. It is an asset class that's doing particularly well right now. I see people allocating money to it, and I just think that it's a potential hedge against inflation. Seen as sometimes a potential safe asset, because gold isn't producing any goods or services. It's not making people's lives better. There is no profit. There is no dividends. There is no revenue. It's really just more of a fear asset. And I don't like making decisions based on fear. I like making decisions based on data and good information. And I like owning companies that are producing goods and services that are making our lives better. That's what I think makes a lot of sense and I think is going to serve you well. I like Warren Buffett's quote about gold. Here's what he said once. Good old Mr. Buffett says, "It gets dug out of the ground in Africa or someplace. Then we melt it down, dig another hole, bury it again, and pay people to stand around guarding it. It has no utility. Anyone watching from Mars would be scratching their head." Maybe that's how we make decisions. Would people from Mars, if they're watching us, what would they think of the decisions we were making? And so maybe that's Warren Buffett's wisdom for investing. Okay, the next thing that I want to talk a little bit about is this idea of a melt up. People have talked about a stock market melt down. Now they're talking about a stock market melt up. And really, you can make a real strong argument for this idea of a melt up. And here's some of the data why you could argue for this. Number one, back in 1998, there were 7,562 publicly listed U.S. stocks. Today, when I looked at the Centers for Research on Security Prices U.S. total stock market index, there were 3,495 U.S. publicly traded stocks. So we've seen the number of public companies cut in half from 1998 till today. So there are fewer investments, fewer businesses that you can invest in today than there were 20 years ago. That's the first argument for a melt up. The second argument for a melt up is that the Federal Reserve has been creating a ton of money. I mean, they just, with all this quantitative easing, with all the printing of money, with sending people actual dollars in their bank accounts, I mean, there's just a massive amount of dollars floating around, and people have to do something with that money. Now, they can spend it, of course, and some people they need to spend it because they're in survival mode, but there's a lot of people that don't need to spend it. And so then the question becomes, what are they going to do with those dollars? You're going to stick it in the bank and earn zero? You're going to buy a 10-year treasury bond and earn less than 1% to lock up your money for 10 years? Or are you going to invest in a company that has the potential to make our lives better with the goods and services that they make? And so we are, in many ways, I think the Federal Reserve, they have committed to creating inflation, unfortunately, or fortunately, as depending on how you look at it. You could say that really the only inflation that they've really been successful at creating is inflation in the stock market and inflation in real estate prices. Is it possible that we're in the middle of a market melt up? Absolutely. Do dollars need someplace to go? Yeah, they do. And are there fewer companies to invest in today than there were 20 years ago? Yeah. Publicly listed companies, yes, that's the case. And so as money tries to find a place to go, in my opinion, that we will continue to see stocks outperform, especially when compared to bonds in the long run. Okay, the next thing that I've had a couple of people ask me about recently is asset-based long-term care insurance. Now, if you've read my book, Sound Retirement Planning, I've got a whole chapter in there on long-term care and the argument for why you should probably consider long-term care insurance. Again, remember, we don't want to make an emotional decision about insurance. It's either you need it or you don't. Sometimes I hear people use a rule of thumb and they say, well, if you've saved $1.5 or $2 million, you don't really need insurance. And that's such faulty advice because it's the assumption is just because you've saved $2 million that your spending is low. And frankly, what I find is that the more money people have saved, the more they tend to spend. So what you need to understand is how much you spend, not necessarily how much you saved. So if you're only spending $60,000 a year and you've saved $2 million, well, sure, maybe you can self-insure. But if you're spending $250,000 a year and you've only saved $2 million, well, you might need to look into insurance as a possible way to protect your family. Again, the only way I know how to do this is to create a year-by-year cash flow plan and then stress test the plan to help understand whether or not insurance is really needed or not. Using rules of thumb can sometimes get you into trouble. So just because you've saved $2 million, don't make the mistake of thinking that insurance is off the table for you. Now, that being said, I know nobody likes buying insurance. I don't like buying insurance. As many of you know, I personally own long-term care insurance, and it's really this thing that I dislike. I pay for it every year, and I can't stand paying for it. My wife and I, we're young, we're healthy. We don't think we're ever going to need it, but the reality is I've seen it firsthand. I've seen the impact that it's had on people's lives.